Good morning, this is Ken Long from Tortoise Capital Management. I want to walk you through a case study on volatility trading and intraday trading that is bi-directional. This is January 30th, 2013, and I'm talking about some trades from earlier this week. So one thing that we have observed about the risk Z, which is the VIX index, the 30-period moving average divided by the 10-period moving average, and then computing a Z-score statistically, looking back the last 5,000 days for reference on the standard deviation. And then this is a time series of the last 180 days of that risk Z. And currently we have a risk Z that is that's been above 2.0 standard deviations, meaning that the 30 period has been much higher than the 10 period on a historical basis, and it can only stay that extreme for a certain amount of time. In fact, if you look back at the previous 5 examples, you had here's a case where it only got to 1 and then rolled over, a half and rolled over, got to 1.5 and rolled over, got to 1.5, stayed there about 8 days and then rolled over. Now for 8 days we have been at an extreme reading for about 8 days, and it's rolling over. So when it rolls over, what that means is that we're starting to see an increase in volatility, and now suddenly the 10-period moving average is starting to converge back to the 30. And that could be a signal for a shift in the relative volatility condition inside the market, or increased volatility coming. If we zoom in on the spreadsheet we used to compute that, you can see over the last 10 days or so, there was 1, 2, 3, 4, 5, 6, 7 days in a row where it was over 2, and then on the 28th it declined even further and came under 2.0 on the Z-score. So that's sort of an indication that the previous truth about this low volatility may be changing, and since volatility tends to change very sharply in anticipation of price, that's one we want to get out in front of early. What's that look like? Well, over the past month, if we look at uvxy, the double inverse VIX, it goes down when volatility declines. And so this is a month chart on an hourly basis, and what we just want to show here is just how much volatility has really come out of this market. And the uvxy has declined from 28 down to 11 over the course of a month. And has been a steady decline. And then if you notice in the last few days, this downward pressure has started to modify, and now is starting to roll back up. The white line is a 30-period regression line. And so you can see there's some indications that volatility may be coming back into the market. Then if you look at the short VIX short-term ETF, SVXY, which goes up when the VIX goes down, it's had this long run from 60 up to 90 in the past month, and now in the last few days has really started to roll over. So there's some indication now that we could be due for a reversion to the mean on volatility. For reference, that period of volatility of the last 30 days, that decline of volatility has been correlated with this gain on a daily in SPY. So you see that this gain over the last 30 days has been accompanied by a dramatic decline in volatility. So being reversion to the mean traders in this case, and being aware of the potential for a sharp increase in volatility, our target would then naturally be uvxy. But because it's early in the trend, we're going to let it develop a little bit. So here we are intraday on the 29th of January, and the blue line is the open. This is a 3-minute chart. The river is plus or minus 1 standard deviation on a 30-period Bollinger Band, 2-period Bollinger Band forming this ribbon-looking shape of price. Black line is the 30-period regression. Blue is the 10-period regression. Dashed purple is the VWAP, volume weighted average price. So market opens at 9:30 local, my time here in Central. Or I'm sorry, that's 9:30 Eastern. Sorry. So that's the open at the blue line. There's a gap up comes down, finds support at the bottom of the river, moves up, makes a new high, comes down, finds support at the Bollinger Band mean of the river, starts taking off, and that's sufficient evidence for me to say that, well, yesterday's close may be acting as a low, and with two subsequent higher lows, I'm ready to play this on a support and resistance basis, and I make my first entry here at 11.38 with a 30-cent stop. Would take it down here about 11.08, so below yesterday's close. Is my 1 hour risk, and it starts taking off, so monitoring that one. It climbs to the top of the river, gets to 1150. We've got about just maybe 0.4 R in hand. Starts decaying, decays, comes back to the river as it crosses back over to VWAP, and we're at no lose by this point. I don't want to have almost half an hour in hand and then lose any money on this trade. So we're out at 1138. The rest of the market had rolled over, started going back up, and so this caused us to quickly shift over into TNA, which is the triple leveraged Russell 2000 ETF, and so it's going up, and the small caps are better than the large caps. So this signal to get out of UVXY is like a failure of the volatility play. It couldn't make a new high, and failing at the Bollinger Band mean. And so that's sufficient to get into the next trade, which is then a sideways quiet channel. It should read 2013-0129 TNA, and so it had chopped around, failed, finds higher lows. It makes a regression line crossover here, comes back into the river. We make our first entry at 77.08 with a 30-cent stop, gets us down here around 76.78. It goes through the Bollinger Band mean quickly, holds, leaves the river here. I'm thinking about stalking the second entry right here, but I want to see it clear this previous swing high of the day at the blue line. It holds stable, holds at the river, takes off again. I put my second entry in at 77.58. Again with a 30-cent stop, so we got just under 2 R in hand, but with some momentum. That unfolds here, holds at the regression line, makes a new high, but really doesn't take off any further, and now price is starting to decay once more. We're getting in towards lunch. I decide to exit at 77.70 and cash 2.5 R. Shortly thereafter, it went up to 77.80. We tried a re-entry. It failed, back for a no lose, a scratch, and that was about all there was for the rest of the day. And we closed up shop early. I wasn't feeling too well, so that's a combination trade there. It was based initially off the volatility estimate. There was initial indications that volatility is coming back in. When that failed and the rest of the market was responding, then we revert quickly, immediately, by battle drill to looking for the longest, strongest indexes to get onto that move early. We do that with TNA in this case, and we take a bread and butter trade for 2.5 R over about an hour's worth of work. So that's Ken Long from Tortoise Capital. Thanks for your kind attention.